Hello, this is Kirk Spano and Scott Shooter Henderson. Teresa will not be joining us. She's off gallivanting around the world again. I don't remember where she is this time. Does anybody remember where she is?
I think she's whale watching.
Is it
That's
Europe? No, she just came back from whale watching.
oh, okay.
I don't know.
She's whale watching somewhere outside of Europe. I don't know.
She's acting like she's retired and made a whole bunch of money in the stock market.
Yeah, she did really well on crypto.
So I got the semi-annual report written. Normally it's a quarterly outlook, but middle of the year we'll make it a semi-annual report. It's at both websites. And I think the short story is this, and I actually put a short story at the bottom here, right? The stock market is overvalued. The smart money has been selling to the dumb money, and dumb money is defined as dumb. The dumb money is basically the trend followers. Those are people who just kind of put it in there and they let it ride and then they complain when it goes down. So the dumb money is really all the indexers, then all the people who are small and all they do is buy because, hey, if it's going up, I'm brilliant. So that's really the definition of dumb money. It's not that they're stupid per se. You know that I have said that the millennials have become very good traders. So I don't think of them as dumb. However, right? There's always, when somebody says something like that, like, oh, there's a but coming. Well, but there is a lack of fear and a lack of respect for risk right now that I've only seen really 3 other times in my career. I saw it in 1999. I saw it in 2007, and I saw it in 2019. And I think we would have gotten a big correction in 2020 without COVID. Everything had started to turn over pre-COVID, but then COVID happened and everybody blamed everything on COVID. Well, the reality was that we weren't in great shape to begin with. And part of the inflation that came out of the COVID bailouts was because the supply chains were goofed up to begin with, and then they got more goofed up because of COVID. So the understanding of COVID and the monetary and the fiscal and the supply chains, I don't think that they're fully understood yet. I don't think they're fully appreciated. And I don't think that the risk that's in the market today is fully appreciated. And I have seen some charts flying around Twitter and the trading rooms and Discord that they're manipulated charts, and they're charts that people don't understand. People see these charts and they say, "Oh, the government's printing money." Nope, that's not what they're doing. I'll explain that in a second. So we know that the M2 money supply generally leads the stock market. So when the M2 money supply goes up, unless there's some event or something tragic or valuations are just so incredibly overvalued, asset prices generally go up. More liquidity leads to higher asset prices. And this is not something I'm making up. Anybody with any type of knowledge of what's going on knows that liquidity leads asset prices. Always been that way, always will be that way. So the main thing that you need to look for to be able to kind of predict a stock market correction is, will liquidity turn over? Is there a problem with liquidity? And right now, what we are seeing happen in real time is that liquidity is slowly drying up, and it's probably going to turn over around New Year's is what it looks like. We can measure these things. And that's why I've said that if liquidity starts to fall next year before Jerome Powell is out, then there will be a correction. And the thing is that the market will start to see this in the next month or two, right? It's not like the market says, oh, look, just this is happening now. No, the market's looking 3 to 6 months ahead kind of religiously. So if I can see that the M2 money supply is kind of topping out, everybody else can see it too. And that is why the professional investors have been increasing their net short positions. So you have the mutual funds that are now fully invested, right? There's charts out there for that. The mutual funds aren't really holding any cash anymore. They're all in. And the ETFs, by definition, are all in for the most part. There's a handful of managed ETFs that aren't really consequential to the market picture, that maybe are holding some cash. And you've got the retail investor that has just been buying and buying and buying and buying because, hey, the trend is up. We haven't breached the 10-day or 20-day or 50-day moving averages, much less the 200-day moving averages. We've really only flirted with the 10-day. And the trend just is holding up. So dumb money is really just the trend followers. And the problem with them is that in the past, the market would turn over, and then over a period of 2 to 6 months, they'd all get creamed. Well, as we saw earlier this year, it did not take 2 to 6 months for people to get creamed. It took about 6 weeks. So the market is moving faster and sharper. The changes of direction are less gradual. And that is because there is twice as many people who are trading now than were 6 years ago pre-COVID. I think that there is a very strong possibility, and I did a couple of little questionnaires, some polls, that the millennials, when we start breaking these moving averages to the downside, when the 10-day moving average gives away on the S&P 500, you'll start to get a handful of people who say, oh, that's a warning sign. When the 20-day breaks, a lot more people will consider it a warning sign and they'll get out. And when the 50-day breaks, you're going to start seeing a lot of people get out. And when the 200-day breaks, now by then the market's probably down 20%. You'll get your blow off bottom. Now, if there's an event, if there is some sort of shock, if the economy somehow slows down dramatically, given the valuations of the S&P 500 now, and some of the small mid caps, but mainly the S&P 500 that represents like 90 some odd percent of all market cap, there is a risk that we see not just the 2022 lows again, but we see the upper end of the 2020 price range. So, we're looking at a potential 50%, 60% correction if the economy tanks. So you need to just be aware that we have to watch and see if the economy is going to tank. Right now, there's not really anything out there that's super scary. There are things that have been going up, but now they're going up less fast. There are a handful of questions with employment. The bond market has been choppy. We are close to the end, I think, of the worst 5-year period in the bond market, 2022, so 3-year period. It's been a very long time since we've had interest rates go up and just hammer the bond market. We think that interest rates, if international investors continue to be, let's use the word judicious about their bond purchases, if international investors actually pull back from investing in U.S. bonds, given that we're going to need to finance more of them because we're running an even bigger deficit now, then interest rates could go up to 6 or 7% is what Jeff Gundlach is saying. I think that sounds about right to me. If there's an international buyer's strike on U.S. debt because they're just all pissed off and they gang up, they could break the system. And if they do it in a way that's coordinated enough, they can probably get over us, right? The history is that you don't want to cause the United States to have a recession, and you don't want the United States to have a recession because that gives everybody else a recession. We're in a situation now where the debt is so big, though, that if they don't finance it for us, and they are the ones financing quite a bit of it, then we have to print money. So I think the world is going to back off on buying our debt and force us into a position where we print money, devaluing the dollar. And President Trump doesn't care. In his head, he thinks that lower value of the dollar increases exports. It won't. And the reason that it won't is because it really never has. There's some around the edges sort of things that have happened historically, but lowering the value of your currency isn't really the big driver of exports. It's technology and labor costs, right? So how good is your technology and what are your labor costs? So for a very long time, we had the best industry because we had the best technology in our industry. And don't just think of technology as, your computer. I mean, we just have had better machines. We've always had better machines. Or if we didn't, we stole them. The idea that we haven't committed massive industrial espionage over the decades is kind of silly. You can read about it. It's all out there. There's movies about it. So, if you don't read. And I think that the rest of the world, frankly, is so pissed off at us right now that I think they're going to back off on buying our debt. So far, it hasn't mattered because there's been enough American money to make up the gap. I'm not so sure that without quantitative easing that lasts much longer. So I have really been trying to find a scenario where we avoid quantitative easing, and I can't find it. I don't see how we avoid quantitative easing. I really don't see it. I think that there is going to be a mini crisis next year and that we get quantitative easing. Or at a minimum, they start monkeying with the repo market like they did in 2019, and they do quantitative easing. But remember, it's a special facility. They won't call it quantitative easing. It's just, this is the special facility, $1 trillion worth for the repo market. And they will fund the banks through the repo market, and they will do quantitative easing without calling it quantitative easing. Now, the Fed balance sheet will expand, which has not been going on, right? So the Federal Reserve has been unprinting money. And for all the folks who think that we've been printing money, you're wrong. We have been unprinting money since 2022. Now, do just the 5-year chart. This is what it looks like, all right? Now, you do the 10-year, you can see the big jump up because of COVID. $3 trillion, and then a couple trillion more. So probably this extra money probably didn't need to get done because they've gotten rid of it. So this original bailout is probably all we really needed. But remember, Jerome Powell just kept printing, right? The money printer goes brrr, and then they unprinted it. This was the banking crisis, okay? This is repo. This is the last time they did the repo funding. This wasn't quantitative easing right here. This was a special facility that bailed out the repo system in the second half of 2019, and then COVID. So this was the 3 banks that went under in March, April of 2023. Special facility, not quantitative easing, okay? And this is the unprinting of money ever since. And this is leveling off right now because they've essentially quit buying back the treasuries, right? They're just renewing them now. And the mortgage-backed securities that they were buying, they're winding that down too. Not as fast as the treasuries, but the reduction in money supply from the Fed is clearly it's been, it's $2 trillion, over $2 trillion lower than the peak. Now, but people say, but look, M2 went up. And this is the chart that everybody is showing on Twitter. They're just showing the last 3 years. They don't even have the guts to show 5. Well, I want to show you something. All right. This is not a big deal, right? That's just not a big deal right there. If you take a look at why has this kind of formed kind of a cup, what is that? They were draining the cup through quantitative tightening. And what did Janet Yellen do? And now Scott Bessent has been doing. What have they been doing? They've been issuing shorter term debt that comes due more often. And what did President Trump say? It was either last week or the week before that he was in favor of doing. He was in favor of just continuing to re-roll that debt and not retire any of it forever, right? 90-day notes, 1 year, right? 1 year bonds, 2 year bonds. They've been doing 2s. He wants to just keep on recycling the money. And that's all that is, right? So when you take a look at this sharp move from COVID, and then from here to here, that's not the Federal Reserve. That's the Treasury Department. The Treasury just keeps rolling the debt to short term. So it just keeps on coming back. None of it is socked away for 10 or 20 or 30 years anymore. Almost all of our debt is super short term, which means that over the next 5 years, almost all of our debt comes due, right? There's like 23% or something that's longer than 10 at this point. It's over half of our money is due. half of our debt is due in the next 5 years because we just keep doing 2-year notes. And so the 10s that come due, 2 years. The 5s that come here, due 2 years. The 20s that came due, 2 years, right? You see how they're scrunching them all together? So as bonds came due of different durations, they didn't do another 10, another 20, another 30. They did 2, 2, 2, 2. And they've been compacting. So now we have this huge amount of debt due over the next 5 years. When you take a look at M1 and M2 together, which is basically your cash and everything in the bank, you can see that this is the part of the chart they're showing you. I wish they didn't have that thing that popped up, right? They show you this up here on the top. This is what they show you. M2 is at a record, man. The market's going to the moon. Does that really look like it's a big change, right? You could draw almost a straight line across, can't you? Right? It's almost a straight line across, almost a straight line. The year-over-year change in the money supply is even more interesting to look at. So here's COVID, straight up, right? And then sucked it all out. And then the bonds that were coming due that were issued all through here, they just kept doing 2-year renewals. So they took what should have been renewed at a longer duration and they made it a shorter duration, and it just keeps coming due. Well, the problem is we've done so much of that now, I mean, really throughout the Yellen tenure as Treasury, and now Besant is doing it too, that we just have this big, huge clump of debt coming due. And yeah, we can just keep rewriting it, but we can't rewrite it without the Fed expanding its balance sheet much longer, because there just isn't people to keep renewing this debt at such short-term durations unless interest rates stay high. Who's going to take almost nothing, right? Who's going to take almost nothing? Yeah, remember, the government just doesn't magically issue the debt and some magic beast sucks it up. There's got to be somebody out there willing to lend the U.S. government the money. I don't think it's going to be the international markets to the extent that they have been. And I don't think it's going to get cut in half or anything, but I think it can drop, 5, 10, 15%. And that's a big deal at the margin. And by the way, with the big skim bill now getting passed, we need to borrow another trillion and a half dollars over the next year, and then $2 trillion the year after that. The idea that this tax bill is going to pay for itself through growth is frankly nonsensical. When Reagan did this, it was kind of a break-even proposition. When George W. Bush did it, we got the financial crisis. And ever since then, we have actually created more debt than we have gotten back in growth. It was a little bit better under Obama and Biden than it has been under Trump and Bush, but, bad and worse, not good and bad. So this debt problem that we have now, which you have never heard me bang on until this year. Since college, I have been on board with Dick Cheney. The debt doesn't matter. Why? Because we never got past the midpoint line where we couldn't get out of it. And now we're so far past that line, and then we just doubled down, which is a Trump thing to do. We doubled down, and we're going to generate even more debt. So the only way to solve this is to print money, is to create inflation. And they can bitch and moan about modern monetary theory all they want, but that's what they're doing. So it is what it is. You just have to accept that it is in the game plan to do quantitative easing. They are not even trying to avoid it, not even a little bit. They might call it something different when it happens, and I'm pretty sure it happens next year, and they'll need something that feels like a crisis, or they can talk about being a crisis so they can do it, right? Because people, stomp their feet and pound their chests every time we print money. Oh, man, they're devaluing the dollar. Fiat currency, man. Fiat currency. I'm going to put everything in Bitcoin. Well, this is a very pro-Bitcoin administration. I think, and I'm trying to coin the phrase, I think we're going to get a Trump and dump. So I think between now and next year, there is some corrective measures in the market. Something will scare the system. Something will be scary enough to create rhetoric that gets us the quantitative easing that they want to do. They'll devalue the dollar, and Bitcoin will go to the moon, and tech stocks will go to the moon, and industrial stocks that use tech well will go to the moon. And then at some point, because the debt won't have gotten better, and the obligations for retirement, for the retirement system will have gotten greater, just a function of aging, right? That's nobody's fault You're trying to get older, right? You're not trying to die. Then we'll have a real crisis towards the end of the decade. And rhetorically, they'll blame it on something else. Oh, it wasn't us. Or it'll be, well, but everybody screwed this up. It wasn't just us. Whatever. I am so over the politics at this point that I just call them as I see them. I understand rhetoric. I studied it. I understand the psychological impact of rationalizing our place in the universe and belonging to a tribe. My tribe is baseball and poker, and I'm kind of mad at baseball because I don't like my owner here in Milwaukee. So if you're super political, especially if you're not thinking about things the way that I'm laying them out, then whatever, man. You're just rationalizing your existence in the universe, and that's fine because everybody needs a place. But if you're trying to figure out what to do next with your investments, I would like to remind you that John Maynard Keynes was a one percenter. He understood how this system worked. He understood how the psychology, the rhetoric, how inequality, how everything impacted the system. George Soros, who is one of the biggest supporters of freedom the world has ever seen, also understands how the system works, so he makes money on it. And I've told you, I understand how the system works. My job is to make money on it and then do something good with the money. So get over the rationalization of your political beliefs. You want to vote for somebody because of some social issue, some religious issue, whatever. That's your business. But I'm telling you how the money works. And I'm mostly right. There's things I'm fuzzy on and I got to figure out too. But if you just follow the big money, you're going to get there. And the big money right now is saying, we want to create a blockchain-based economy. We really want to pump up Bitcoin. And we might get an altcoin rally here that is unbelievable. And I hope that the altcoins spike, because that means that Bitcoin might languish and I can buy it back, right? Because my trading Bitcoin, I'm not in right now. I still have my cold storage. I'm not going to sell those. I told you when I would think about selling it. But I can't see a way that in a world where we really don't have any choice but to print money at some point, I think next year, maybe it's a year longer, but I think next year, I think it'll be before the midterms, because they'll want everything, to be good and all the asset prices to be going up, see if they can buy some votes. When the quantitative easing comes, and I'm telling you this because I want you to prepare yourself mentally and psychologically, you're going to want to buy freaking everything. And everything are the things that were going up well and that the government favors. What does the government favor? Bitcoin, domestic industry, natural gas. That's what the government favors. So that's what you should invest in. The best tech, the best industry, natural gas, some metals, right? Rare earth metals, and Bitcoin. Now, you can fart around with the altcoins and Ethereum and everything else, but I'll tell you, back in 2020, when I suggested that you buy Ethereum, buy 32 of them if you could, so you could be a validator. We bought it. It was basically a 9-bagger because I sold it in January. I told you I sold my Ethereum and Solana. Everything else I had, I sold in January. And people told me I was dumb because, hey, I only made 5 to 9 times my money over 4.5 years. And they've, in some cases, made 20, 30, 40% on theirs this year, but I'm dumb for making 5 to 9 times my money. The reality of the altcoins is this. You get value from those from the income that they generate. In the case of Ethereum, the yield is only 3 to 4%, right? Because that's what they're making on the transactions that they process. And if you have somebody like I had a guy, I don't even understand what he was doing. I was getting a couple extra points. There's like bonus points and bonus fees and stuff with Ethereum. I'll ask Shooter about it in a minute. I don't even know what he was paying me for. I know he was taking about half. He was only supposed to take 25%. I'm pretty sure he was taking half. And I sold him my Ethereum. I said, hey, dude, I'm going to sell my Ethereum. Do you want to buy it or should I just put it out on the market? He bought it from me. So he bought my 32 Ethereum. And would I buy it back? Maybe. But if you're buying it on the speculative idea that somehow it's kind of like Bitcoin, it's not. Ethereum, Solana, these are all substitutes for software as a service. So you got to take a look at the total addressable market and how much they can make on the transactions. And the thing is, you're going to make less with blockchain-based solutions because the whole point of blockchain is to charge less than what software companies are charging you. So I actually think a blockchain-based economy, while it may make sense as a consumer, if quantum doesn't steal it all, right? That's the other thing. Quantum computing requires even more security that we might not be able to provide. We just saw one of the biggest Bitcoin wallets out there that had been dormant since 2011 or something just had a massive transaction for billions of dollars. We don't even know if that's a real transaction or if it was hacked and stolen, because the quantum computing is getting so powerful. And it's not even really quantum computing. We're so far away from quantum computing that, you know, it's kind of like fusion. But the change from what we had to what we have and to what we're getting is so big that people don't understand that, you know, quantum should be like just so much more powerful. But when you add, you know, 10x to the power, people are like, oh, that's quantum. It's not. That's not what quantum is. It's just 10 times better than what we had. And that means that the security can't keep up. So I think there's all kinds of hacking and blockchain going on right now. And I read and I can't prove it, but the patterns that I'm seeing are similar to other times when it turned out to be theft or crime or fraud. So be careful with those particular things. Bitcoin, same thing. You're better off trading it through IBIT because that's basically insured. It's not insured, but it kind of is insured. And then your actual coins, you got to keep it off the internet. You got to have cold storage that can't be hacked in any way, because most of us aren't sophisticated enough to do anything but protect the password. So I do think that we get quantitative easing. I think that's really good for Bitcoin. Maybe I should have not traded it this last time, or I should have just bought it when it got back into the 70s. I missed. Oh, well. I do think Bitcoin is going to 300,000. I can't figure out a way that it doesn't. And with this administration, it might go to 1 million. As far as equities go, most of the rest of the world has been printing money the last couple of years because they were basically in a recession. And that, along with the FOMO in America, has pushed MSCI index as high as it's ever been. When you compare the real M2 to purchasing power, you see that it's starting to get out of line, right? It's kind of average right now, and it's not supposed to go up here, but it might. So we might get one more rally before a big problem. If you're a trader, you can ride it. I think the easiest thing is to just keep selling cash secured puts on your favorite stuff, because if you sell cash secured puts over and over again, you know, you're only a month or two out. So unless the world changes overnight, you're probably okay, right? We just keep using our technical indicators, selling cash secured puts, pulling in 5% or 10% premium for holding some cash in a money market for a while, or a month or two or three. And if our stock if the stock that we're selling to put on, you know, drops 5 or 10%, hey, then we buy it cheaper. And the odds of it moving that much that fast are pretty slim. Now, I'm sitting on a ton of cash because I've been waiting for a summer lull to sell a whole bunch of puts on. Hasn't happened quite yet. I showed all the different valuations in here. You know, the stock market is very overvalued, right? Buffett indicator, highest it's ever been. Stock market is very overvalued. This is all sorts of other price to earnings ratios, super overvalued. The Schiller 10-year CAPE is about 38 right now. Says that the S&P 500 should return around 0 or less over the next decade. Price return. So is that going to happen? I don't think so, because they're going to print money again. They're going to do QE. And since the QE age, price to earnings ratios have been higher. So we have perpetually overvalued markets compared to basically pre.com since QE started. Let the genie out of that bottle. Does that mean the S&P 500 is going to do this again over the next decade? I doubt it. It's going to be in here somewhere. So some single digit return. That's what Goldman Sachs and Morgan Stanley say. I'll go with them. So it is time for our special guest star, Scott Shooter Henderson, who's going to tell us about treasuries. Are you still awake, Scott?
Look out below.
All right. So for TLT to fall off a cliff, that means that interest rates on the long end of the curve have to go up, which of course would be bad for the economy.
Yeah.
So you're saying from this chart that the trend is showing and that your analysis is showing that gun luck is probably right and we're going to get higher interest rates and TLT is going to get whacked?
Yep. That's what the chart says.
That's what the chart says. What does Scott say?
I'm mixed on that. As long as that $83 holds, 82.42.
Right here?
Yeah. I mean, we could build out a flat right there for 2 or 3 years. So, you know, the one thing Elliott Wave doesn't measure is time. So that becomes very challenging. When you look at the historic flats, and you can't really see it in this chart, we've been there for 3, 5, 7, 8 years, not at this level, but in the past where we built out flats. So that is a potential outcome. So I'm not trading it short, let me put it that way, because I still think there's going to be an event that gives us a decent pop shortly, or it should happen shortly, where there's all of a sudden a flight, and it's going to push yields down for a bit. We're starting to see that in the shorter time frames, I think.
Well, then that's where they can manipulate the most, right? They can manipulate the shorter term way more than they can manipulate the long term.
I mean, you hit the nail right on the head when you said they've rotated towards shorter term. I mean, also crypto and the stable coins, they're using the leverage from the shorter term debt. So, and that's less than 90 days is what they're using to, which is the guarantees on any stable coins that we're creating at this point in the new regulation that's out. So, right. I'm mixed here because we didn't get a breakout on the last high. We rejected price. So, one thing about treasuries for me is I find it very hard to grasp them in a longer duration because they're manipulated so much. Because we don't see it. Well, the only thing is what we see is what they tell us or they want us to know. So we don't know what kind of backdoor deals they're making, for example, with Saudi Arabia as an example. I mean, supposedly in this recent...
They're the big one.
Yeah. I mean, in this recent deal, they agreed to buy some treasuries, but I haven't seen it on the books.
Right.
So, I mean, those types of deals we don't see. We don't know what they're doing, and that's not disclosed to us. So that makes it challenging, really, to grasp it. But the chart says... the history of this chart suggests that we're going into wave 3 and that we should push down below 75 in that wave 3. That could build out a bleeding flat there as well. And, we could, bounce before we get to the 382, which I would say is as likely as us holding out a flat.
So let me throw out a scenario here. Let's suppose that Saudi Arabia and the non-Iranian countries offset what Japan and Europe don't buy anymore, which again, I think would be a single-digit percentage reduction, and what China is selling, which has actually been pretty aggressive lately. So in the case where there's some offsets to tepid demand from other sources, right? Mainly, I think it would be OPEC. If Saudi Arabia is buying our treasuries in enough quantity to offset what Europe and Japan don't buy, and interest rates don't spike up to 7%, then what you're saying is that this could chop around here for a while.
Yeah, multi-years.
I happen to think that's the most likely scenario. I understand what Gunluck is saying, that it could spike like this, but I think the Saudi Arabians are there. If they're not, right, if Saudi Arabia isn't buying the treasuries that Japan and Europe are buying less of, right, they're not stopping, they're just buying less, then we might get 7% interest rates. And if we get 7% interest rates, Luke Grumman is saying that that's the way to fix it, is have high interest rates for a while and basically have a mini depression. I don't like that idea. I don't think that we ever need to have a depression. I think there's always ways to fix things. I just think that we're 2 steps away from the edge, right? We're not leaning over the edge of the abyss yet. We're still 2 steps away from the abyss.
The sinkhole's getting bigger.
Well, but if you think about it as standing at a ledge, 50 years ago, we couldn't see the ledge on the horizon. And we have just kept getting closer to the ledge. And now we are 2 big steps away. And that doesn't mean we're going to go over, but it means that we're only 2 big steps away. And I think that this budget that they've done is the first step. I think it's going to turn out to be the first step. And then the boomer retirement would be the second step. We have to mitigate these 2 things. Now, tariffs are never going to be more than a couple $100 billion a year. And the golden passport is never going to be that much money, right? All the things that they talk about aren't really that big of a deal. Now, of all people, I was listening to Pam Bondi say that, look, she came right out and said it. She goes, the mass deportations are going on because we're just going to have robots do stuff. We don't need them. And the able-bodied people on Medicaid, which she made it sound like there's a lot of them. There's not. It's a single-digit percentage, right? Almost everything has a single-digit percentage of fraud and abuse and waste. And okay, so let's say we clean up 10% of the Medicaid cases. Hey, great. It's 3 million new people in the workforce part-time because they ain't going to work full-time. If they wanted to work full-time, they'd be doing it. So she basically came out and said robots are the solution. And that is why I have really been working on studying robotics and drones. And I'll tell you what, there's a lot of stuff out there that has very interesting insider investors, and these stocks have not moved yet. They're very undervalued versus the total addressable markets that they address. So the total addressable markets for robotics and drones are pretty huge because of what they replace. Now, socially, if all that money just goes to 1% or 2% of the people, and we end up getting unemployment of 5, 6, 7, 8, 9, 10%, then you're talking civil war. So we better make money on this quick, because what I was talking about with Soros, reflexivity, which I don't even know that I got to that part of it, the snapback is almost always pretty severe, usually more than what it needs to be. And that's why you're seeing people vote for socialists right now that are, this guy in New York, he's a communist. And I don't say that lightly. Yeah, but he says this and he says that, and I like it. Yeah, whatever. Rationalize all you want. Dude's a communist. And, and again, I don't say this lightly, and that I'm pretty blue. And I hesitate to use certain words, but, he is not a good dude if you study his past. So I get that he says things that appeal to people the way that President Trump says things that appeal to certain people. But if you follow the money or you follow the ideology, right? This guy in New York, Mamhadi or whatever his name is, he is communist second. He's something else first. And he appeals to people as a snapback, right? People are disaffected, and they because they're looking in one direction and blaming that direction, they snap back and they go in the other direction and they go too far. And they completely go through equilibrium, or the balance point, which is what markets are supposed to address over a long period of time. Over a long period of time, we find equilibrium, or at least we pass through it. But the pendulum has been swinging further and further up, right? Up and out. It's not a little tick-tock, tick-tock. It's gong, and then zoom, gong, and then zoom, gong. It's not tick-tock, tick-tock, tick-tock. Oh, that's kind of soothing. That's not the way things are right now. So when it comes to investing, understand the extremes that are out there and follow that big money, and you'll make money. And then, like I said, I just hope you do something good with it. I have been giving away solidly 10% of my money for a very long time. Somebody asked me about that in Vegas this year. Said, hey, I saw your name on something. Said, yep. Normally I do it anonymously. It was a slip. So you're going to make money if you pay attention to what I'm saying. And if you want to trade it, you need to be in Scott's room, because, I don't trade much, but I've been reading more and more of what Scott's doing, and the freaking trades are ridiculous. Scott, you're sick. I don't, if I could do what you do and not piss off the regulators, I would do it. So that is where
you'd be pissing the regulators off.
Well, I can't. Yeah, I am. I could piss off the regulators. I'm not going to kill my golden goose, but regulators won't let guys like me trade the way that you trade. And the thing is if you're good at it, it's spectacular. If you're bad at it, that it's because 4 out of 5 people are bad at it, and they just say don't do it because we don't know if you're good or bad.
Challenging now. I mean, I don't think I've worked this hard in a long time.
Well, but you're killing it. So yeah. So for folks who aren't in the rare trading room, if you have that 15 to 20 hours a week to be a trader, then have at it. If you don't have 15 to 20 hours a week to trade, then don't do it. All right. I want to take a look at the dollar here, because I actually had a Avi sighting. Avi thinks that the dollar is going to have a rally. Is that what you're showing too?
Now, you got 3 drives in that last little mound there. It could. But I think it's more likely an ABC, if that's the case. In other words, an internal ABC in the last leg. So we'll get it bounce back to maybe the 50 fib, and then it'll keep going. It'll extend the down further, and the whole map will change. So from the yellow dot up to the 50 fib, stop. That'll be where it becomes an ABC, and then we'll flush back there.
So Avi is saying that
We do get a rally. I think so. I would agree with him, but it's shorter term.
It's getting ready to reverse, and I didn't read and see where he said it was going, but he said it's based, the dollar's about to bottom and go on a rally. And I don't know how he saw it rallying. But where the dollar has gotten to, I told Dale 3 or 4 months ago it was going to get down to make a run at 90. And it started to, right? It's really come down a lot pretty fast.
Yep.
So this is saying in here you probably get a reversal. So this could be within weeks.
Yeah, the by October, I would think.
Well, Dan Niles, who I think is pretty good, him and I agree on a lot of stuff. So obviously, I think he's good.
Just so you know, the dollar tends to run. So October 22, we had a bounce, right?
Okay. Well, he said that come the fourth quarter, he was worried.
Yeah.
Which is what I've said. I said this looks a lot like 2018 to me.
Yeah.
Which means
we had a similar rally in October of 20 as well.
Yeah. So I think it'd be a choppy rest of the year. All right. So let's finish with, and folks, I already chatted up Bitcoin. I'm not going to show you the charts. You need to get into service for that. S&P 500 looks to be topping.
One count, yes. I have another count that's extremely bullish. Right. I mean, what I see here when I look at this, I see two peaking drives that have come out, in the larger structure. Wave 3 is really elongated or extended. And now we're in wave 5. Now, if wave 5 breaks much above about 645, then it opens up for a much more extended 5, which could put us up to 680 or 690.
So if liquidity holds up, we could get a rally all the way up to around 700.
Yeah.
So if liquidity holds up. Okay, what if liquidity starts to dry up and the market recognizes that?
It's going to flush right back down to trend.
So, and can it overshoot this trend all the way down here?
Yeah, it could.
So
right now, the bands, I don't actually have it on this chart, but the bands that I have in the chart, I don't think we get below 505 again. I mean, okay. I might be wrong, but I don't think we break below the 382 fib on this chart.
Okay.
505.83. The structure is too, the argument here is, do you use the 2009 low as your anchor for your count, or do you use the 2020 low? And we've had discussions about that, but when you do the comparisons on the chart, you have substantially different counts. If you use the 2020 low, the impulse wave is about 60% more euphoric than where we are now. This right now, the count that you see here is off of the 2009 low.
Is there any methodology? Because I use this 2014 to 16 sideways consolidation.
Yeah.
As kind of the start of history, because that's when we got back into QE, or we got out of QE and then back into QE. So to me, this is kind of the worst it can get. Right? I can't see going.
I've seen it in both directions, more extreme than is there. That's one reason I look at, specifically when I look at corrective legs, I look at equality, I look at extended, and then I look at elongated. And there's even a little bit further, deeper than that. So when the right components to a market retrace come in, or a correction, just look what happened in COVID. If we look at the lows that came in there, that was an extreme event. Now, no one could really conceive that prior to that happening. It wasn't even on anybody's radar. And, the liquidity there's a major issue going on in the yen right now, and it has been. And if the dollar keeps pushing too much lower than where we are now, it's going to cause things to break in Japan. And, my biggest concern is the yen carry trade unwinding abruptly. And even the tariff news that Trump announced on Japan could trigger that because it's going to change the margins of all of that borrowed money that's currently in U.S. equities. And I'm estimating it's about 12%. It might be as little as 8, or could be as high as 15 or 17%. I really couldn't fact, but I'm guessing about 12% of all the capital in U.S. equities comes from the yen carry trade. And that's a big enough exodus to panic everyone else. And that's the kind of panic that I'm concerned about. It's still there on my radar. I'm trying to keep some kind of insurance there, even as we rally here, because I do recognize that we're going to pull back regardless. And the question is, how deep does that pullback go? Is it shallow to the 382? Does it go more towards equality at the 50% fib? Or do we get some extremes and start pushing the 618, which is a little oversold, or the 78.6, or does it even flush further and go down to the 161.8, where you just have like a 3 or 5% outlier event? Those all can be factors in what we're looking at. What I think is really unusual here in how I'm seeing this chart is there's so much divergence between one starting date and another. I've not seen that in my career in analyzing charts. And that's something that just sticks in my craw. So if I start at 2009 versus the 2020 low, I have completely different outlooks on how bullish this is. Then when I drill down and I look at this current motive wave, we have the most aggressive euphoric motive wave that we've had in the history of the tape of the S&P 500. There's nothing been more aggressive than this as far as its slope, its extension, etc. We're constantly pushing the 161.8 on our extensions when you look at the shorter time frames. So in that sense, we're totally overbought. But when you look at the count, I would say that 762 is a little conservative, because if we are going to keep running, we're going to run.
If there is a wave of liquidity, which I don't know where it would come from, I understand what you're saying. So to me, because I go all the way back and I look at the 1990s, because I think that 1994, really 87 a little bit, that was a shock. But 1994, because of what the bond market did, I think was kind of the start of that period of history. So from 94 to the financial crisis was the pre-QE period. And then since the financial crisis has been the QE period. And I haven't seen charts that look like today's since 1998 and 1999. And the valuations are pretty high. The difference is that the lack of quality that was in NASDAQ back then is now in the Russell 2000.
Yeah.
So the Russell 2000, 70% of the stocks are shit. But it's also where you get your biggest winners because they're small, and if you can find the ones that grow, right? Small companies grow into big companies if, they don't go out of business or just suck, for 20 years. I think that this has to get back down to that trend line. And my question, which I don't have an answer to yet, is how fast can that happen? And how low do things have to go for Powell to do QE? He's already farting around in the repo market. And what would it take for the next Fed chairman to do QE? So I think the trend line is enough for them to do a special facility, right, to act more in the repo market. I don't know what it takes for them to actually go to Congress and say, hey, we want to do a thing. And the thing that I think they should do, right, and I actually think they might, what I think they should do is they should create some sort of 30 and 50-year bond, maybe even a 100-year bond, and make the Federal Reserve buy it and only put a 2 or 3% coupon on it. And just say, hey, Federal Reserve, you're going to take out a mortgage on America so we can get through all this demographics and stuff. I think that it's a smart way to do it, because then that money kind of resets the system. Now, do you get inflation? For sure. However, it's not as much inflation as if they just spray paint the banks with money. Remember back in 2020 and 2021, I told you all that I just got so many credit card offers. I started taking them all. And so I have, way into 6 figures of credit line through credit cards. And I'm getting these offers again. Citibank wants to give you a 3rd credit card. Right? I mean, Capital One, Discover, they're basically the same now. I'm getting, this Credit One company, some company in Omaha. I mean, I'm getting 3, 4, 5 of them a day. You're not pre-selected. They don't even say pre-selected. You're pre-approved. You're getting credit. We just don't know how much yet. So suddenly the banks in the last 6 or 7 or 8 weeks, it's been pretty recent, are throwing out credit card offers again. I don't know if you're all getting them too, but they dried up for a couple of years and suddenly they're back. I don't know if that has anything to do with them changing the reserve requirements, the SLR, the how much capital the banks have to keep on the side, because they really want the banks to buy some more treasuries. The thing is that the banks don't have enough money to really move the needle. I mean, they can help it. They basically can fill the hole for about a year, maybe two. So here's the thing. If the banks fill in the liquidity gap for a year or two, as the hedge funds and private equity and other private credit people rationalize their risk, we could avoid a really gigantic correction for a while and just kind of chop. And I think maybe we get one of those 2014 to 16 periods where it's not horrible, right? Maybe this just consolidates in this range until it gets to the line, or maybe it gets to the line and goes along the line before it takes off on QE. I don't know. I don't know what the triggers are and the timelines. I really think they want to print money, though. I think they want to print money.
Well, that's what a boom and bust cycle is.
I think they really want to print money because they really want to make a ton on Bitcoin and then abscond with it. That's what I think. I think they want to spike Bitcoin hard because it is the easiest way to steal money. Absolute easiest way to steal money. So I could be wrong about that. I'm just some Sicilian kid who has done all right by following the big money. And I think the big money is in robotics and owning companies that are involved with robotics and drones and automation. And I think Bitcoin. I think natural gas is the easy one because there's almost no downside. Based on the value of some of the stocks that we own, right? Permian Resources, Katera, a little bit of Matador. They have like no downside. I mean, can they have volatility 10 or 20% in either direction? Easy. Can they go to zero? Not in the next couple decades. I mean, these companies are cash rich. They don't drill a hole unless they're getting paid, right? There's no wildcatting speculation going on. It's all math. So, I don't think you're going to make a mint on natural gas investments, but I think you can grind out if you're selling options because energy is volatile and you get good premiums. You can beat the S&P 500 just selling options on some of these things that have volatility but low lose your money risk, right? In my opinion, I would like to hear what Scott says to this. In my opinion, and I go back to that commercial from 20 years ago, 25 years ago, channeling stocks, Bob. That's how I'm retiring and quitting my job. I just buy it at the bottom and sell it at the top. Well, I don't think it's quite that easy, but I think that selling options, selling puts in particular, on stocks of companies that have very low financial risk, but do have volatility because of what they're in, like technology or energy, I feel like it's the easiest money I've ever made. And granted, it's not home run money, but it's like stringing together single after single after single after single. You're going to score. That I just, I don't need to do it on biotechs that could go to zero. Right? I can do it on natural gas stocks and companies that are profitable, but because it's technology or energy or pharma, to some extent, right? They don't have that going to get crushed risk, right? That permanent loss of capital risk.
When you've had such a great year like I have, believe it or not, that's my biggest fear is that I give half of it back. So I'm hesitant, and that comes from experience because, when you've gotten crushed, it's that little guy, green guy sitting on your shoulder or blue or whatever he is or she, where you're like, well, wait a second, this happened. It's like, it's sort of like my conviction with the VIX at this point. I remember at the initial downturn after 2020 and we were looking at HYG. Well, I didn't last long enough. Ultimately we got the complete correction. We hit my target, $30 lower from where it was. It's so I think selling cash secured puts is a prime example. And I'll just throw out mRNA here. It's a name that we're in swing trade notes. It's at a historic bottom, has nothing but upside. It's like a no-brainer, just rinse and repeat selling cash secured puts on. It's like a no-brainer. Just keep getting paid. It's a printing machine.
Yeah, and even that one's a little bit risky for me.
Yeah,
because I don't know enough about it. But I think there's a lot of stocks out there that are a combination of volatile, yes, but not tremendously high risk.
Right.
And that,
like Steady Eddie. Even American Express is a good one.
For sure, American Express. But here's the thing: people equate volatility with risk,
Yeah.
and they're not necessarily the same. They're different animals, and I just think that people need to understand that is that a company like American Express doesn't have a lot of risk, but it can be volatile.
Yes.
So if you use the technical indicators to sell cash secured puts closer to the bottom, right, somewhere between the middle and the bottom, right, you don't have to be perfect because time, if it gets assigned to you, the calendar is going to fix it eventually.
Yes.
So anyway, somebody put in here that he thinks that Alex. I've been seeing your post, by the way. I've seen your comments, Alex. There will be QE before the interest rate goes above 5%. I don't know if that's necessarily true. However, they're clearly dabbling in the repo market. They had a big intervention last week's shooter? They did the big intervention in the repo market, or was it 2 weeks ago?
There was a decent piece.
Yeah.
What was bigger was the Bank of Japan, though.
Yeah. Well, but I'm just talking about the Fed. The Fed put extra money into the repo market for like 2 or 3 nights because something was going on last. I think there was just some recycling that needed to be done, and the banks couldn't handle it without that.
OpEx.
So yeah, and so I don't know that how regular it is. I think it was just had to do with expirations.
Yeah, we had quarterly expiration.
Yeah. So, but it was the Fed stepped in because even on an event as simple as expirations, the banking system couldn't float the overnight debt. So the Fed stepped in, which isn't completely uncommon. I don't know what the number is for them to do quantitative easing outright. I think it is a mini crisis or something that feels like a crisis. And I don't know exactly where that interest rate is. But I will tell you, TLT, if it's chopping around 80, I don't know that it's enough upside for me, given the potential downside into the 50s. But if it gets to the 70s or the 60s, I probably, because interest rates have gone up into the 5s or 6s, I'm buying TLT because, now it's getting to the point where when they take interest rates down to 1 or 2%, I'm doubling my money. So, the easy equation here, just in case you don't know this, duration times the change in interest rate is basically the shortcut to knowing how much you can make. So if the duration is 10 years, right, well, TLT is 20. So if the duration is 20 years and the change in interest rates is 4%, right, that's 80%, that's a double, right, because rule of 72. So if you think that interest rates are going to drop 4%, and I think certainly they would if we got to 6, you can double your money when that happens. It might take a year.
You can straddle that.
Well,
you got 4% coming.
Yeah. The TLT trade, here's the thing. If it gets down here, right, because it's been way up here, it's 185, right? We're already in the area where if we get ZERP or NERP, right, near zero or zero interest rates, even from here, it can double. But if it gets down in here, it's a potential triple. So do you start buying TLT in here with interest rates? Because this is when they got like 4.9, right? So this is kind of 5. This green line is kind of 20-year rates are, and really 10-year rates are around 5%. This is, 6, 7. So I don't know that we see 6 and 7, and I don't know exactly what triggers QE or something like QE, right? It's, a special facility. I don't know what the triggers are politically. I just know that we have to be watching it very closely and think this through ahead of time so that when they start doing things, you go, well, we've been thinking about this and we're going to watch. We know where we have to get in. And I think that this is kind of a hard place to buy, which means maybe it's right. This is an easy place to buy. So you can make the hard trade, or you can be like me and wait till it gets closer to being an easy trade. I'd probably get in here. But because I'm not too concerned about being perfect, because I do think that we are going to see super low interest rates sometime after Powell.
Right? There's no choice.
Should we call it AP?
Yeah.
After Powell.
Yeah.
Interest rates are going down and they're printing money.
Until we get the debt brought back down, that's the only option. It's either that or sacrifice the treasuries. It's so. I think the argument of whether or not they sacrifice the treasuries or the stock market, I think they sacrifice the stock versus the treasury. is my personal opinion.
Right. If the stock market goes to hell and unemployment goes up 2 points,
Yeah.
then they spray paint
5
money.
points from where we are.
Yeah,
I
they
mean,
spray
it's-
paint money. And remember, they're all invested in Bitcoin.
Yeah, I know. But see, Bitcoin has shown some stability. I mean, right now we should be rallying, but we're not. But at the same time, every time we have a drawdown in equities, we're not seeing that same wash in Bitcoin. I mean, it's relative strength right now, which is a good thing. So just like when we started hearing everything with the wars going on and everything, look what happened to Bitcoin initially. It dumped, but it rallied back hard and broke out the highs. So I mean, I think it's not a replacement for gold, but I think what we're seeing is that global migration. There's a lot of people who are buying Bitcoin versus treasuries as a flight to safety. I think that's what we'll see, and I think that continues as we move forward with different events. So, like right now, I think we're on our run to 125K now. As a matter of fact, I highlighted, I think I had 107 as my stop that I adjusted. Because I don't think we should get below 107 based on how the flag looks at this point, and whether or not we put in 121, 123, 127, somewhere in that range. I think only time will tell, but right now we have all indications that the adoption is continuing. More people are buying into this. It's going to continue to grow at the same percentage or a little higher than it has. We have that expansion in capital in that. So I think that becomes a flight to safety and continues to do so.
We'll see. All right. I've had enough.
Okay, good.
Let's call it a night. Thank you very much, Scott. Thanks for
appreciate you having me.
Yeah, Alex. Thanks for the comments. One thing to keep in mind is the Treasury only has so much balance sheet, right? Because it's legislated. They don't really print money. The Fed does, but Treasury just can adjust their balance sheet a little bit based on what they've been given. So we saw the Treasury spend down their balance sheet because they had to take extraordinary measures to keep us from defaulting on the debt. And now they're rebuilding their balance sheet through Treasury issues. So there's a much narrower range on what the Treasury can do than what the Fed can do. The Fed can print $2-3 trillion. The Treasury can't do that. It's in the billions, right? It's smaller billions. So we need to watch the Fed. And I think the easy answer here, and I'm not the only one saying this. I mean, this is all over the place. I just said it, first. I was saying it before Trump was president, that whoever the Fed chief is after Powell is going to be a money printer. So I'm just waiting for the memes on the next one, right? I mean, they had Powell, with a crank spitting out money, right, with a money printer when they sent out the pictures and the memes on Powell. I don't even know what the next guy is going to be. What's the next guy going to be, or woman? What's the meme going to be for the next one who prints more than Powell printed? Because I think it's coming. Now, does it all happen during this administration, or does it have to happen a little bit after? And I will still tell you this, because of the cyclical nature here, and just because certain things in history repeat, 2029 is shaping up to be a really horrible year. And, it could end up being 2027. It could end up being 2035. But if things play out similarly the way they have in the past, and the world is moving faster and with more volatility, sharper moves up and sharper moves down, has seemed to be the case since 2016. Yeah, I think there's going to be a 1-2 punch. I think it's going to be a punch, then it's going to be the reaction, then it's going to be a bigger punch, and then we'll see what they do about that. But let's worry about the next 2 things and the next 3 things before we worry about 4 or 5 things from now. So I think that you're going to get an opportunity to sell a lot of cash secured puts, and I'll have the punch card stocks out. It's really actually going to be a little bit more different than I thought. I'm going to put it all together, stocks and growth. Everything's going to be in one list. It's about 35 stocks, it looks like it's going to be. And, I never own all 35, but I want to give you some choices. But I do think that the half of those that I end up owning, I err on the side of the ones with the biggest upside and the ones that I can sell puts on over and over again that I can't get blown up on. So we'll see. By the way, got to finish with a Metis. If you haven't bought a Metis, I think that everything in that big bill is so positive for Ametis with the 45Z got extended, and their RNG, just the renewable natural gas, is going to be so profitable by next year. And they're actually, I think they're going to be profitable this year. I don't think they're gonna be a money losing operation anymore. And I think, and I can't ask him this because I don't think it's public, but I'm trying to figure it out. I think that Ametis is making enough money now because of the renewable natural gas that they don't have to print any shares and sell them with their ATM. The stock price has doubled off, or is it tripled almost off the bottom? And I told him, I can't wait for you to stop the ATM, right? Selling shares to finance operations. I don't think they are anymore. And that means that this is going to rally, and it's going to rally hard. Fundamentally, Ametis is worth over $1 billion net of debt. So keep that in mind. All right. Have a fantastic day.